To cut or not to cut? That's the question for Australia's banks. So far, the Big Four have delayed any announcement about whether they'll pass on the rate cut the Reserve Bank announced yesterday. The Treasurers savaged them and urged customers to take their business to smaller lenders. But the banks are citing higher funding costs as the European debt crisis sparks a new credit crunch. Here's Stephen Long.
Down 25.
Hubbub in the dealing rooms as the Reserve Bank cut the cash rate yesterday.
Markets are experiencing considerable turbulence, finance conditions much more difficult, it's all about credit.
Then a deafening silence from the major banks, prompting the usual outcry from Canberra.
I understand that many families and small businesses will be very angry if there is not a full pass-through of this rate cut by the banks in the system. I believe that banks should pass this rate cut through in full.
For my money at the moment, I think they're playing chicken about who's going first and whether or not it's 25.
With blame Europe as the ready-made excuse for not passing on rate cuts in full.
We've got a new global credit crunch. It's not as intense as it was after Lehman's failed, but it's emanating from Europe. The European banks are huge players in the global scene. That's causing bank funding costs to go up, and that's why our banks are sitting there wondering, can we pass on the mortgage rate cuts that the RBA sort of, in a sense, opened up the scope for with yesterday's cash rate reduction?
Short-term money has become more expensive. The long-term market is so expensive that it's effectively shut. No banks around the world are accessing that market.
Deposits are paying higher interest too as the banks compete harder for customers' money. Recently, ANZ and Westpac raised money in the global markets through a new form of finance called a covered bond, backed by the highest quality Australian mortgages. The cost, the interest rate, was so punitive the other banks gave up. A sign of the times is that BHP Billiton can now borrow money in the global marketplace cheaper than the big banks can, even though it's got a lower credit rating. But if the bank's costs are going up, so still are their profits to near record levels, and their shareholders are rewarded handsomely.
Bank profits have gone up over the course of the crisis. Bank profits are in fact almost as high as they have ever been if you measure it by return on equity, and that's around 18%.
They are among the most profitable banks in the world. I think that is understood very clearly by their customers. And if their customers are unhappy with the behaviour of their bank, they can go down the road and get a better deal.
At the end of the day, it's just the balance, isn't it, between what you pass on to the customer and what you pass on to the shareholder.
Jamie McPhee runs ME Bank, which is backed by the not-for-profit industry super funds. It scored a marketing coup by immediately passing on the full Reserve Bank rate cut and taking a swipe at the retail banks.
If they don't pass on the full amount, in effect what they've done is take some of the benefit of the RBA rate cut and give it to the shareholder rather than give it to the customer. And, you know, our view is in this economic environment, the appropriate thing to do and the fair thing to do is pass it fully on to the customer.
So what's ME Bank's share of the market?
It's about 1.5%, Stephen.
There's about 150 banks, building societies and credit unions all competing to lend people money, along with non-banks. And yet, as much as we like to bitch and moan, people stay with the majors, which loom larger and larger.
To a certain extent, you can ask what competition? One of the byproducts of the global financial crisis was the big four banks' competition got decimated. A lot of the non-bank lenders were actually put out of business. A lot of the second-tier banks got gobbled up by the big four. So what we have now is the big four banks are in an almost unprecedented position of dominance in the domestic mortgage market. So really it's almost like a cartel, and they're all facing the same funding pressures, and they're all sitting there going, well, will we, won't we, pass on this 25 basis point reduction?
Banks could absorb the increased funding costs into their profit margin, but there are plenty of pressures on bank managers and bank boards not to do so, because what motivates them most of all is to increase returns to shareholders and in turn to increase returns to themselves through their bonuses.
Regulators won't mind if banks fatten their profits at customers' expense. They want them to hold bigger buffers against potential bad times to come.
Banks have a responsibility to make sure that they are safe and that they are stable, and they are seen to be safe and stable, particularly when there's so much nervousness internationally. Australia is a small part of the world economy. International investors don't spend a lot of time looking at Australian banks. They need to see strong headline profits to be satisfied that we remain one of the safest places for them to invest their money.
If the GFC revealed anything, it was that push come to shove, big banks worldwide are backstopped by governments. Too big to fail, guaranteed and subsidised by taxpayers. And in these circumstances, how much profit is too much?
Stephen Long reporting.